There are two powerful price action concepts that, when combined, form one of my all time favorite entry models. Liquidity, combined with trend lines, is actually the foundation of most of my trading strategy. In this session, I'm going to break them down for you in a simple and practical way. I will walk you through how they work, how to use them together, and share a complete entry model and trading system that you can start using right away to spot high probability setups and boost your trading results. So, the first one is liquidity. We will go through the impact of high and low liquidity in today's video. And the second one is the concept of trend lines. I hope you have got the chance to go through the video I made about trend lines, which tells deeply about how to draw the trend lines correctly. In today's video, I will skip the details and will only focus on how the trend lines work along with the liquidity concept. To learn about trend lines overall, please go check out my other video. I will mention the link in the description box. So, if you have ever felt like the market is out to get you and triggering your stop losses before moving in the exact direction you anticipated, this strategy will show you exactly why that happens and how to finally turn the tables. So, here is what I'm going to cover: how market makers trap retail traders and how to avoid falling into their traps. I will go through the market maker model so you can start seeing the market through their eyes. We will also figure out how to identify real liquidity sweeps and to filter out the fake ones. Plus, in the end, I will walk you through real nifty example step by step from setup to profit. Today's concept works for scalping, day trading, and swing trading across stocks, commodities, and futures. So don't miss out on watching this video till the end. So, are you ready? I hope so. Alright, let's dive in. First, let's talk about the traps market makers set for retail traders. You know that classic double top pattern. Price hits a resistance level twice, struggles to break higher, and then starts to reverse. It looks like the perfect short setup, right? So you enter a sell, and like most retail traders, you place your stop loss just above the resistance. But here is what's really happening. Market makers allow that resistance to hold just long enough to attract sellers. They know your stop losses are sitting just above that level. So when enough traders pile in, they sweep the zone and triggering everyone's stop losses. So this isn't just a breakout, it's a liquidity sweep. They use your stop losses to fill their own sell orders. And once they're done collecting liquidity, the price drops hard. Exactly like you originally predicted, but you are already out of the trade. This double bottom trap works the same way. Price hits support twice. You think, perfect, this is strong support. I am going long. You enter the trade, place your stop just below support, and boom, price breaks the level and triggers your stop losses and then rockets back up. Sounds familiar, right? It's another liquidity grab. Market makers buy at a discount using your losses as fuel and then drive the price up. Even trend lines, which seem super clean and reliable, are used against you. You see the price respecting a trend line, bouncing off it again and again, and you are thinking, next touch, I am entering. And so you do. You enter on the bounce, stop loss just below or above the line. But instead of bouncing, price breaks the trend line, takes out your stop loss, and then immediately reverses back. Again, it's not a trend line break, it's a liquidity sweep. Market makers know where your stops are. They manipulate the market to trigger them. get the liquidity they need, and then resume the original trend. Same thing goes for support and resistance level. You find a clean support level that's held before, you enter a buy and place your stop just below it. Looks safe, right? But but the price breaks down through the support, hits your stop, then turns around and bounces sharply. That breakdown wasn't real. It was a trap, a liquidity sweep to trigger stop losses and buy at a discount. Resistance, same story. You short from a clean resistance zone, stop loss just above it. Price spikes up, triggers your stop, then reverses hard. These are not accidents, they are engineered setups. Market makers don't trade like we do. They can't just dump massive orders in, they need liquidity, and that is your liquidity. Market makers do not trade like retail traders. Always remember that. They can't just dump massive buy or sell orders into the market. If they did, price would spike or crash instantly, causing chaos and slippage. So instead, they break up their large orders and spread them across specific areas on the chart, what we call as supply and demand zones. So they are intentionally built by market makers to attract liquidity. These zones are where price frequently reacts and they are not random. So here is a trick. When market makers want to buy, they create a demand zone by placing smaller buy orders. This makes price bounce up, giving the illusion of strength, but if they need more sellers to fill their buy orders, they will push price below the zone temporarily. That move triggers stop losses of retail traders who bought the bounce and attracts new sellers thinking the zone has failed. But boom, liquidity is created. They fill their buy orders and price shoots back up. So when they want to sell, it's the opposite. They create a supply zone by gradually placing sell orders, price rejects and drops, but if they need more buyers, they push price above the zone, grabbing stop losses from short sellers and luring in breakout buyers. So once liquidity is there, orders are filled, price drops sharply. Now that you know how market makers trap retail traders using liquidity sweeps, now let's talk about how to actually spot where institutions are operating. I have developed a proven set of criteria to pinpoint the exact zones where smart money is active. So let's break it down step by step. Candle size and momentum. This is the first one. Look for large, bold candles, all moving in the same direction. These are not random. They are the footprints of big institutions entering or exiting positions. When you see clean, impulsive moves, especially breaking through minor consolidations, it is a clear sign market makers are involved. Freshness of the zone. Here is a golden rule. Stick to zones that have never been tested before. The first time price returns to a fresh zone, that's where the magic happens. It's the highest probability trade. Why? Because institutions often leave unfilled orders here. And the first retest is when they come back to finish the job. Break of structure. Another key signal is a break of market structure. If price breaks a significant high or low with strong momentum right after forming a zone, it adds extra confirmation. That breakout is often institutional strength clearing weak hands. Here is the deal. Don't even consider to trade unless the zone offers at least a 3:1 risk to reward ratio. That means for every $1 you risk, you should aim to make $3 or more. This way, even if you win just 40% of your trades, you are still profitable over time. So let's put this into action with a demand zone setup. So big institutions like banks and hedge funds can't just buy all at once. If they did, price would spike and they would get horrible entries. So instead, they buy gradually, creating a demand zone where price repeatedly bounces. Here is a critical moment. When price dips below the demand zone, it triggers stop losses of retail traders who bought early, and it lures in new short sellers thinking the zone has failed. This creates a liquidity institutions need to complete their buy orders. Once filled, price often closes back inside the zone. That's your signal. Enter long and ride the institutional wave up. This strategy works on all time frames, but only if you use proper top down analysis. Here is how to align your trade. If you're trading the 5 or 15 minutes chart, your higher time frame is the 1 hour chart. If you're trading the 1 hour, use the daily chart for bias. For 4 hour traders, check the weekly chart. And if you trade the daily, always refer to the monthly chart. This helps you avoid trading against a larger market trend, which is a mistake most retail traders make. All right, enough of the theory. It was important groundwork to help you understand what I'm about to show you next. Let's jump straight into the trading view where I will walk you through how Nifty has reacted around its decent support and resistance levels and how it has respected a key trend line and how market makers have executed liquidity sweeps right in front of us. So if you can see the Nifty 50 chart over here, I have drawn few resistance and support levels and few trend lines. All right, so let me go through the trend lines first. So I mark my trend lines in red, the downward trend lines, and I mark my upward trend lines in blue. So it gives me the clarity like what I'm looking at. And if you see the support level, this is what I've marked as 21,897 and resistance at 24,200 level. So this is just for the example I've taken a day time frame. I'm just trying to explain the combination of liquidity C sweep and the trend lines and support and resistance zones. So when we combine all these factors, we can actually clearly see where the market is going and how the liquidity sweep works. So if you look at the level of 21,897, so this is how the liquidity sweep happened. This was the area where the market gave a major support last time. So market makers knew that if they bring the price of the Nifty just below it and eat the stop losses of all the retail traders, and boom, they bring the liquidity back in the market, and the Nifty went up. And if you watch the Nifty chart on daily basis, this happens again and again. So this is the day time frame I have taken, but if you look at the date, the time frame of 5 minutes, 1 minute, 1 hour, 4 hour, this happens all the time. So no matter what time frame you are trading, whether you are an intraday trader, whether you're a swing trader, or whether you are a positional trader, this concept works all the time. And that's what is like I am predicting for now. So this is a liquidity sweep which is happening. So why do you think Nifty has gone straight up from 21, almost 600 level to back to 24,200 level? So there is a liquidity sweep which is coming up. And if the market falls, we have a huge risk to reward ratio at this point of time. So this is what I wanted to tell you through my today's video, that this is our reality. Liquidity sweeps happens. We as retail traders think that okay, the Nifty has hit the resistance zone, this double the double resistance, which we were talking about in our earlier video. This is what the Nifty has made. It has made a top. Traders might have thought, okay, this is a tested scenario area. Now the Nifty wouldn't go from back down from here, but no, Nifty went up. This is what the liquidity sweeps looks like. This is where all the retail traders have made the losses. So here is your takeaway. So trading is a liquidity game. If you start thinking like market makers and try to spot their traps and entering after the sweeps, you will stop getting shaken out and start taking trades with real momentum behind them. So if this strategy helps you, drop a like, subscribe for more, and let me know in the comments how it worked on your charts. I would love to hear your experience or questions. Thanks for watching, and as always, happy trading.